Today, I'm going to go through a client case study to give you a complete picture of what investing for an early retirement looks like. And you're going to learn how to connect your investment plan to your overall financial plan because you just cannot separate the two. And hopefully, this will help you understand what your portfolio might look like if you do plan to retire early. And the reason why I'm making this video is because I have this conversation all the time with people that reach out or first start working with us. And I notice that although they might be in a really good position savings wise, they start to realize that the same investment strategy that got them here over the past several decades is not the same thing that will make them successful over the next 30 to 40 years in retirement. And the bottom line is 10 years ago, they could have made mistakes, and that's fine because they still had time to recover. But now they understand that the stakes are a lot higher now because we only have one chance at this retirement thing. But when it comes to investing your portfolio for retirement success, there are three obstacles that you need to think about. And without understanding these, it can lead to some pretty big mistakes. So we're going to go through this case study and you're going to see how we address these three obstacles with some good planning. So let's meet Dave and Amy, not real names. And as always with these case studies, we remove some of the details for privacy, and I'm gonna really hone in on what's important and what can help provide value to you. Now, both Dave and Amy wanted to create a plan to retire in about a year. They would be age 59 and 58 at that point, and early retirement by all means. But before we talk about the first obstacle we had to overcome, and that many of you will also want to think about too, let's look at their balance sheet, because the types of investment accounts you pull from to create retirement income can really change the trajectory of how you invest your money. So I'm using round and general numbers here for privacy, but if we break things down just by account type, they have cash and CDs around $100,000, and they also have a joint brokerage account here of around $680,000. Dave also has a 401k that has around $800,000. And then finally, Amy, her 401k is around $500,000. And then under the assets, other assets here, their home residence, which is based here in California, is valued around $1 million. So if we're just looking at assets they expect to spend from in retirement, that puts them right below $2 million in total investments. Now, next below here, we do still have a liability of a mortgage that's a little over $200,000 remaining on that mortgage. So with about $2 million saved across a few different accounts, in a minute, I'm going to show you how much they can expect to spend from this portfolio. But that is going to be dependent on if we can address the first obstacle that naturally people are going to have when they start investing for retirement. And to explain this, I need to introduce you to Benjamin Graham, the mentor to Warren Buffett. And what he has to say about this article is this: the investor's chief problem and even his worst enemy is likely to be himself. Now, that's right. Oftentimes we can be our own enemy when it comes to investing for retirement. And let me explain why. Now, every year Morningstar compiles a study called Mind the Gap. And this year they found that fund investors earned a 6% investor return, which reflects the impact of cash inflows and cash outflows from timing the market or getting spooked. But over a 10-year period, while their fund holdings generated a return of 7.7% annually over the same time period. So basically, investors suffered a 1.7% annual return shortfall because of missed timing. They also found that the more volatile the investment, the larger this gap. So obviously some people make good choices while others make poor ones, but in order to overcome this obstacle, you need to have a system to protect yourself. I tell my clients this all the time, but I'm up against 1,000 talking heads on the financial news networks trying to sell you on the world burning or the panic sell. And we don't want to time the market wrong and get poor returns. And what was also interesting, what I found with Dave and Amy, I found that Dave is very aggressive when it comes to investing. He has no problem with volatility, and his 401k will reflect that when we look at their investments where they got with us. Whereas Amy, on the other hand, wants more stability. She wants to make sure her money lasts and is in the camp of preserving wealth. So the first obstacle when it comes to investing for early retirement is having an investment philosophy. You should have rules that you can stick with during the good times and the inevitable bad times, and they need to be in writing before anything happens. These are rules for your future self. And the way to avoid these big gaps in returns and help you not underperform is to find something that aligns with your risk, but also having the right rebalancing strategy, investing across widely diversified funds, and that will all help shorten the gap. Because I know there's the scientific answer and give you and tell you, hey, here's the most optimal allocation, but then there's the art side that dives into, hey, you can still have the best retirement imaginable if we dial back the risk. And if we do dial back the risk, will your money still be able to give you the best retirement possible? That's what it's all about. So we know for Dave and Amy, we want to take a more balanced, moderate growth approach. And you're going to see how this all comes together when we look at their portfolio. But with about $2 million saved across a few different accounts, let's see how much they can expect to be able to spend from this portfolio in those initial years if they were to retire next year and we're able to take a more balanced moderate investment approach. Because once you understand how much you want to spend, you can really start to put the puzzle pieces together for building your portfolio. But the second obstacle to avoid when investing for early retirement is really important to understand. And this actually is going to apply across the board, pretty much regardless of your investment strategy. And it comes down to one thing. Now, I talk with most people like Dave and Amy. They're pretty familiar with dollar cost averaging. They were contributing to their 401ks while working, like many of you watching. So they were buying investments on a periodic basis each paycheck. And they're probably not paying a ton of attention to it because it was just automated. It was happening every single 2 weeks or so. Now, if markets dropped while they're working, that's fantastic because they're buying more stock at a lower price. But it's a different story when you're selling investments and pulling money out of your accounts. You're basically doing the opposite of dollar cost averaging. And that is the second obstacle, which is sequence of returns risk. But can't you just follow the 4% rule and just go on with your life? Now, that might work better for more of a traditional retirement. And I don't have the time to go through why this is less optimal. I have in previous videos. But for someone who's going to retire with possibly a 40 to 50 year period of retirement, this could be a pretty inefficient or even dangerous way to withdraw money from your accounts. So we're going to get a little bit into the details here because it's important for people to understand when they're building out an investment plan, the math is going to change when you start going from growing and saving assets. Now you're starting to spend them down. And we want to avoid sequence of returns risk. Now, Dave and Amy ask, as many people do when they start to get retirement, where should I pull income from first when I actually do retire? And how can we spend about $8,000, a little over $8,000 per month while we still have our mortgage and before Social Security kicks in? So what you're looking at my screen is their projected income next year based on that, moderate growth style investment strategy to cover their baseline expenses of $7,000 per month. And then on top of that, we need to cover that additional $1,400 to cover the principal and interest of their mortgage. So after we take out taxes, right, there's a gross amount and the amount you need to take out to get the net number after taxes, about $8,600 for them. So about $100,000 in those initial years of retirement, which is actually about a 5% withdrawal rate. Now, I just told you the 4% rule wasn't the best, wasn't the most optimal thing earlier, but why can they take 5%? The good news is that sequence of returns risk can be mitigated with the right withdrawal strategy. This is why, especially for those we work with who want to retire early, we use a strategy called the risk-based guardrails approach. And here is how it works. For them, we set up those initial guardrails to say, if your portfolio sits at just over $2 million once retirement starts, and you want to spend about $8,000, a little over $8,000 per month to ensure you never run out of money, let's be flexible. So we have a system in place to say, hey, in the circumstance where their portfolio drops by a little over 30%, based on the best research and based on their personal situation, we should adjust your monthly income downward about 5% until things get better. But on the flip side, of course, you get any potential upside. If your portfolio does go up, I want to make sure you're getting that bonus. So your takeaway, whether you can find an advisor that will help you implement this strategy, is this. Since your income is coming from a portfolio now, and you're retiring early, you need to set up a system to reduce some of the pressure and tension on your portfolio when markets inevitably do have a downturn. Because although these adjustments are small, they can give you a way more balanced approach to safely generating income over a longer period of time. So you now have an investment philosophy, a withdrawal strategy. So let's complete this and put it all together and look at what type of investment portfolio could help you support an early retirement. Okay, so there's a famous paper out there where researchers found that asset allocation in overall portfolio structure was responsible for 93.6% of the variation in portfolio quarterly returns. Not stock picking, not timing, not taxes, but asset allocation is what drives overall portfolio success. So let's go back to the strategy which we talked about earlier, which was showing that based on their situation, they have the capacity to spend up to $8,600 per month from the portfolio at the start of retirement. And again, for those initial years, it's solely going to be coming from the investments. They don't yet have Social Security as an income source. So when I'm building an early retirement portfolio, what that tells me is that they need to have about $100,000 per year in withdrawals to cover their needs before Social Security kicks in. And when Social Security does kick in, we're going to want to start to reduce withdrawals so they can still have the same amount of net income, but start to reduce tension on the portfolio. And also, what that tells me is that we need to have the right investments that are more stable on the side in a safer bucket. So, when, not if, markets have a correction during a 40 plus year retirement, they don't have to worry about it. So, in reality, what I like to do is have a minimum amount of funds set aside in bonds and cash. And for them, that looks like around 5 years of withdrawals in a safer bucket that aligns with their risk and what they need. And what we know is that market corrections happen generally about every 4 to 5 years or so, and they last on average about 15 months. So adding that extra buffer can help them sleep well at night. And we'll continue to, of course, to strategically rebalance and replenish this over the good years and adjust when life changes. And we're going to talk a little bit more on the specifics of that in a second. So, for example, for them, 100,000 over 5 years, we want to have that in a more stable bucket, and that could be invested in treasuries, inflation-protected bonds, municipal bonds. Now, not all bonds are equal, which we prefer higher quality and shorter-term bonds, and I'll show you what that looks like in a second when we look at the details. So, of their total portfolio, about $500,000, which is about 25% of their total retirement nest egg, is going to be set aside. And the other $1.5 million or so can be more flexible and target long-term growth. But here's a key point for Dave and Amy and those of you watching. We don't just want to put 75% stocks and 25% bonds in all their different accounts. That's not a tax efficient way to build a portfolio. For them, they have 66% of their assets in the tax deferred and about 34% in the taxable bucket. So if we look at their first year of withdrawals, around $100,000 is coming from that joint taxable account. And then we have $0 coming from any of the pre-tax accounts. Now, what this tells me is we want to think about having a layer of conservative investments specifically in that taxable account as opposed to, all their other accounts, which we are not taking money from. So in those initial years, the taxable account may look more like an 80% bond and 20% stock portfolio, whereas the retirement accounts we can think of as more of a long-term growth strategy. And the good news is that we can change the investments and all the positions within those retirement accounts to be more long-term growth without any sort of tax consequences within those accounts. But of course, that's not going to be the case forever because eventually in 2041, that's when required minimum distributions kick in for them. And maybe their planning strategy might change, tax law changes, circumstances change. And this is why your portfolio allocation needs to match your life and not just be a set and forget allocation for the entirety of your retirement. But what sort of portfolio design can change your retirement picture? Because having a great withdrawal strategy, having the right asset location is worthless if you don't have the right investments that coordinate with those different parts. So before we dive in, I want to make it clear that as always, the investments I'm going to show you here are not any sort of investment recommendation. You need to go do your own research and due diligence, talk with your own advisor or investment advisor about this. The examples I'm going to show you are just for illustrative purposes and should not be relied for any sort of investment recommendation. But I'm going to pull up our portfolio analyzer here and compare their portfolio as they approach retirement and see how their investments might change when they do retire. So here is the total portfolio analysis that we started with. These are all the positions across their different accounts here on the left side and some of the very close proxies exactly for what they had just for privacy. But you'll notice on the left side is all their positions they have across their 401ks as well as their taxable account. Now, a big chunk of their assets were in 401ks, and this starts to play into their different tolerances. You'll be able to see this. Amy opted for a target date fund, which has gotten more conservative as she approached retirement, which are fine leading up to retirement, by the way. But the problem with target date funds, I find that when you need to start generating income, you're going to be selling proportionally from both stocks and bonds when you generate that income, which is not very optimal when stocks do fall. You don't want to be selling stocks when they are falling. You want to be able to specifically target the asset class you want at specific times. Secondly, almost 90% of his 401k was just in a Vanguard 500 index, which did very well for him, but definitely more risky than Amy. There was also some bonds in his 401k here. But overall, as far as their brokerage account, they did have some bonds, which as we talked about earlier, this is the first account we want to pull from. So we'll want to adjust this. But something pretty interesting is that he held a 20 to 30 year treasury fund. Now, the fund was similar to ticker EDV, which is more of a longer term, higher yielding bond type of fund. Now, when it comes to longer term bonds, I always like to caution people because although you might be getting a higher yield, many people got crushed in 2022. I know most of the bond market did, but especially these higher yield long-term bonds. EDV specifically was down in 2022 about 39%. So again, my philosophy is that not all bonds are equal on that front, and most people can't afford this type of loss in an asset that they're setting aside for income. Apart from that, there were some individual stocks that they bought, as well as some mutual funds you can see here. Now, one thing that you'll notice here, and I want you to pay attention to, is I want to make sure you're getting value for the mutual funds you use. For example, one of the funds here is a small cap growth, but the expense ratio is about 2.12%. Now, that's a pretty darn high expense ratio, and I'm not saying this fund is good or bad. I just want you to ask yourself, can you get the same exposure at a lower cost and get the same value and same returns? So again, these funds and stocks make up their entire investment portfolio when we put it all together. But let's now look at the right side of what a potential or proposed portfolio that would better align with your goals might look like, especially if you want to retire early. Again, this is not a recommendation, but the allocation is in alignment with more of an early retirement goal here. So what we said was, why not have a little bit more global diversification, not just in the US, but also international? Because just because the US did well over the past 15 years, it does not guarantee that the next 15 years will be successful. And what if we owned some shorter term bonds, small cap funds, treasuries, and emerging markets to add these different return streams? And for this illustration, I'm just using Vanguard funds because they're very popular, and really it's a lot simpler to kind of tell the story. This is not the exact portfolio allocation, but it does tell the story. But putting together a portfolio like this is very intentional. Each asset class has a different purpose. Each fund has a different purpose. It's not just a hodgepodge of funds to put together and make things seem complex. And that's because the math changes when you do retire early. For them, we want to make sure they have multiple return streams that will perform well, but perform differently at different times to just kind of spread out the risk. So on the right, we have funds like Vanguard Short-Term Treasury, which is not going to grow a ton. And we're also not trying to chase yield like EDV, but what it will do is provide a sense of stability and liquidity that they can really rely on throughout retirement. Again, during years where markets are doing well, these other funds like the small cap or the US markets, if they're outperforming, we can sort of rebalance and slice off some of the growth and take advantage of it. But during the bad years like 2008, we don't want to sell from equity funds while they're dropping in value. For them, especially for Amy, we want to make sure we have around 5 years of steady income in these buckets. And then we can also add different, money market funds and total bond market funds, where if markets are still bad, we also have those other funds to hold up our income before we have to sell from any of those growth investments. So these, again, are not investment recommendations, but the concept behind asset allocation is very important when creating retirement income. So again, if you put all three of these things together and you avoid those three obstacles, you can build a complete investment portfolio that aligns with your plan to retire early. But there's one thing I didn't really touch upon in this video that can make a big difference when someone does retire early, and that is take advantage of the retirement tax valley, which is basically when you retire and your tax situation changes, you can really take advantage of some great tax planning during that window when you retire, and then when required minimum distributions kick in. So I made a video going through how to put that all together, and you can watch that by clicking right here. Again, this is Matt. I'm a certified financial planner and advisor with 1 Degree Advisors. If you'd like to talk to me or someone on my team about your financial plan or your plan to retire early, you can click the link in the description, and we would love to chat with you. Thanks for watching, and I will catch you guys on the next one.